All right, today we're jumping into the world of high-tech semiconductors to take a really close look at a company called Skyworks. Now, they're a huge player in the wireless world, but the real question we're asking is this the kind of wonderful business an investor like Warren Buffett would actually buy, or is there something else going on under the hood? So, let's put on our detective hats for a bit. Is Skyworks this amazing, golden opportunity hiding in plain sight, or is it a classic value trap? One of those companies that looks cheap, but for a very, very good reason. That's the mystery we're going to try and solve together.
And to guide this whole investigation, we're going to use a framework that's been proven time and time again, Warren Buffett's 4 key tenets. Think of these as the 4 sets of clues we've got to examine to crack this case. We're going to look at the business, then the management, then the financials, and finally, the price. It's how we get to the truth.
Okay, let's get right into it with our first clue, the business itself and its competitive advantage, or what Buffett famously calls its moat. A strong moat is what protects a company's profits, kind of like the walls of a castle. So the big question is, just how strong are the defenses around Skyworks?
Well, on one hand, Skyworks has built some seriously impressive fortress walls. Their skill in designing these super complex radio frequency chips, it's absolutely top tier. And the fact that they own their own manufacturing, well, that gives them a ton of control. But look at the other side and you start to see some major cracks. They're up against giants like Broadcom. A massive chunk of their money comes from just one customer, yep, Apple, and they have to spend a fortune on research and development just to keep from falling behind.
And you know what? Those cracks have some very real consequences. All that pressure from big customers and tough competitors is putting a serious squeeze on their profitability. Just look at this chart of their gross margins. That's a key way to measure their pricing power. It's fallen from over 50% just a few years ago down to around 42% today. In our investigation, that is a huge red flag. It tells us their moat just isn't as strong as it used to be.
Which brings us right to our second clue, the management, the people in charge. The generals defending the castle, if you will. Are they making the right calls? Are they steering the ship in the right direction to handle all these threats?
And, the evidence here actually looks pretty good. Management, led by their CEO, Liam Griffin, seems to be making all the right, rational moves. They're pouring money into R&D, which they absolutely have to do. They're giving cash back to shareholders with buybacks and dividends. And, this is crucial, they're making smart acquisitions to try and move away from being so dependent on smartphones. So on this point, management gets a solid passing grade from us.
All right, time for clue number 3. Let's follow the money trail and dig into the hard numbers. The financials? Well, that's where the real story of a business is written. We need to figure out if it's a story of strength or one of weakness.
And at first glance, wow, things look fantastic. The company's 5-year average return on equity, which is a really key measure of how profitable a business is, comes in at a super strong 24%. I mean, that just blows past the usual standard for a Buffett-style investment. It really suggests this has been a highly profitable business for a while.
But here's the plot twist. While that long-term average looks great, the more recent numbers have dropped a lot, down to around 15%. This big decline, it confirms exactly what we saw with those shrinking margins a minute ago. It shows the company is under some real pressure right now, and it's hitting their bottom line clear as day.
So, let's update our detective scorecard, shall we? Okay, first up, that declining return on equity, that's a red flag. But then, look at the debt level. It's incredibly low. That's a huge positive. A big green check mark right there. Then we have profit margins, which we know are under pressure. Another red flag. And finally, free cash flow is strong, but it's pretty volatile, which raises another flag for us. So it's a bit of a mixed bag for sure, but that rock-solid balance sheet is a major point in its favor.
And that brings us to our final and maybe the most important clue of them all, the price. Because remember, even the most wonderful company in the world can be a terrible investment if you pay too much for it. So what is Skyworks actually worth?
And here it is, the climax of our entire investigation. The analysis suggests the company's real intrinsic value is somewhere in the range of $85 to $105 per share. Okay, but what's the market price right now? It's about $105, right at the very top of that range. So what does that mean? It means there is no margin of safety. Zero. There's no discount, no cushion, in case things go wrong. You'd be paying full price, plain and simple.
And really, this one quote from the analysis just says it all, doesn't it? After digging through all the evidence, this is the perfect summary.
Skyworks is a good company, no doubt about it, but it's sailing into some pretty strong headwinds, and the market is asking you to pay full price to come along for the ride.
So now that we've gathered all the clues, we've got a narrowing moat, we have rational management, the financials are a mixed bag, and there's no margin of safety, it is time to deliver the final verdict in the case of Skyworks Solutions.
And the verdict is split. For a new investor looking to buy in, the recommendation is pretty clear. Avoid. The combination of a challenged business and a full price tag just fails that classic value investing test. Now, for people who already own it and who have a pretty high tolerance for risk, holding on could make sense. But you have to know it's a bet on management's big turnaround strategy paying off, and it's not a sure thing.
And you know, this whole investigation leaves us with a really fundamental question that, honestly, every single investor has to answer for themselves. The case of Skyworks proves that sometimes you can find a good, competent company, but that doesn't automatically make it a great investment. It forces you to ask what really matters more, finding that amazing company or being patient enough to wait for a great price.